There's a pattern in the actions of the world's greatest investor that has preceded the biggest market crashes of the modern era. And right now, in 2025, Warren Buffett is following that exact same pattern, stage by stage, decision by decision, almost like he's reading from the same script that he used right before the implosions of 2000 and 2008. While Wall Street tells you the market is strong, Buffett has been executing a massive, sustained sale of stocks. In the last 2 years, his company, Berkshire Hathaway, has sold off well over $100 billion in equities. This isn't just rebalancing, it's a strategic retreat. He has now been a net seller, selling more than he buys for 12 consecutive quarters, for 3 straight years. And this retreat has built a fortress of cash and short-term treasuries that has swelled to a staggering $157 billion. You have to ask yourself a simple question. What does the Oracle of Omaha see that the rest of us don't? This is the story of that pattern, why he always follows it, why the math says a reckoning is coming. And it's happening faster than anyone wants to admit. This isn't about fear. It is about understanding the sequence, because the truths in Buffett's playbook could be the difference between financial ruin and the opportunity of a lifetime. Section 1. The Signal. Deconstructing the multi-billion-dollar retreat. To understand the gravity of this, you need to see the scale of what's happening. The numbers are a blueprint of his conviction. Over the last couple of years, Berkshire Hathaway has been systematically liquidating its positions. In the third quarter of 2025 alone, a net $6.1 billion was pulled from the market. This wasn't a sudden move. It was the 12th straight quarter where more money flowed out of the stock market from Buffett's coffers than into it. This is not a reaction. It is a deliberate, long-term exit from a market that he clearly believes is fundamentally overpriced. And what, specifically, is he selling? This is where the signal gets clearer. For years, Apple was the crown jewel of Berkshire's portfolio. Buffett praised its business, its management, its unassailable brand. Yet starting in 2024, he began to trim the position. Systematically. Quarter after quarter. These aren't speculative startups. He's also reduced his stake in pillars of the American economy, companies he has championed for decades. For him to be selling them now, at this pace, sends a message that is impossible to ignore. He believes the prices are no longer sane. They are no longer tethered to intrinsic value. This exodus from stocks has led to the most important clue in the pattern, Berkshire's cash pile. As of the latest reports, the company holds over $157 billion in cash and short-term treasury bills. Let's put that in perspective. It's a war chest. It is an ark. Why would the world's most disciplined investor choose to earn a meager return on treasury bills instead of participating in a supposedly booming market? The answer is as simple as it is terrifying, because he believes the return of his capital has become more important than the return on his capital. He is choosing safety and liquidity over chasing gains. He is preparing for a world where cash is not just king, but oxygen, a world where those who hold it can survive, while those who are fully invested are wiped out. And there's another layer. Berkshire has significantly slowed its own stock buybacks. Buffett has always said he loves to buy back Berkshire shares when they trade below their intrinsic value. The fact that buybacks have slowed to a trickle tells you everything. He looks at the market, he looks at his own company's stock, and he sees no bargains. To him, everything is expensive. And when the ultimate bargain hunter stops shopping, the rest of us must ask why. Section 2. History doesn't repeat, but it rhymes. Buffett's pre-crash playbook. If you want to understand Buffett's actions today, you only need to look at what he did before the last two great collapses, the dot-com bubble of 2000 and the financial crisis of 2008. The pattern is there, written in history. Let's rewind to the late 1990s. The world was gripped by dot-com mania. Any company with a .com in its name soared to astronomical valuations, whether it had revenue or not. Wall Street was celebrating a new paradigm where old metrics no longer mattered. Everyone, that is, except Warren Buffett. He was called a dinosaur who didn't get it. And what did he do? He refused to buy the wildly overpriced tech stocks. He sold what he felt was overvalued and let his cash pile grow. He was ridiculed for underperforming, but he waited. Patiently. Then, in March of 2000, the bubble burst. The Nasdaq lost nearly 80% of its value. Trillions in paper wealth vanished. And suddenly, the dinosaur looked like an oracle. Now let's fast forward to the years before 2008. The financial world was euphoric, this time fueled by a housing bubble and what Buffett called financial weapons of mass destruction. Banks were leveraged to the hilt on toxic assets they sold as investment grade. Again, Buffett remained on the sidelines. He avoided the big investment banks. And what was he doing? He was building his war chest. Berkshire's cash on hand grew and grew. He found almost no large investments that met his criteria of a wonderful business at a fair price. The prices, he believed, were simply not fair. Then, in September 2008, Lehman Brothers collapsed. The global financial system froze. And it was the moment Buffett had been waiting for. While others were desperately selling to raise cash, Buffett had the ultimate weapon, a mountain of it. He became the lender of last resort, injecting billions into Goldman Sachs and Bank of America on legendary terms. He could be greedy when others were fearful, only because he had been prudent when others were greedy. He had the cash ready. Now, look at today. The parallels are chilling. A market driven by a speculative frenzy in AI. Valuations stretched to historic highs. And Warren Buffett, once again, is a net seller, trimming his most successful holdings and amassing a record-breaking cash hoard. He is not predicting the day the storm will hit. He is doing something far more intelligent. He is building the ark. His actions today are not a prediction, they are a preparation. And they follow the exact same playbook that allowed him to not only survive, but to triumph. Section 3. The 3 cracks in the foundation. Buffett's strategy is a response to deep structural cracks forming in the economy, realities Wall Street is paid to ignore. Let's expose the 3 most critical risks setting the stage for a 2026 reckoning. Risk number 1. The valuation disconnect. There is a metric Buffett himself has called probably the best single measure of where valuations stand at any given moment. It's known as the Buffett indicator. The calculation is simple. The total market cap of all U.S. stocks divided by the country's GDP. Historically, a ratio around 100% is fair value. Before the 2000 crash, it peaked at 162%. Today, as of late 2025, the Buffett indicator stands at over 200%. We are not just in the red zone, we are in territory that has no historical precedent for a positive outcome. Buffett himself warned that investing when this ratio was near 200% was playing with fire. This is a bonfire. Risk number 2. The commercial real estate domino. The second crack is a slow-motion collapse happening in plain sight. The crisis in commercial real estate. Remote work has fundamentally broken the business model of office buildings. But the real danger is who holds the debt. A huge portion sits on the balance sheets of smaller regional banks. We are facing a maturity wall. Between now and 2027, nearly $1.8 trillion in commercial real estate debt is set to mature. These loans were made when interest rates were near zero. Now, property owners must refinance at drastically higher rates or default. A wave of defaults could trigger a credit crunch, starving the economy of capital. Lenders are trying to extend and pretend, but this only delays the reckoning. It doesn't solve the problem that the assets are no longer worth the money loaned against them. This is a domino, and it's teetering. Risk number 3, the debt spiral and the 18-year cycle. The final crack is the largest, the mountain of government debt. The U.S. national debt is spiraling into uncharted territory. For decades, this was manageable with falling interest rates. But with rates now significantly higher, the cost of servicing this debt is becoming explosive, acting like a wet blanket on the entire economy. Now, overlay this with a fascinating and historically prescient theory, the 18-year real estate cycle. It is a hypothesis, not a law of physics, but it has a chilling track record. It posits that economies move in a predictable 18-year cycle, driven by land values, culminating in a crash. If you trace this cycle back, the peaks align with uncanny accuracy to major downturns, the late 1980s, the peak before 2008, and, if the pattern holds, a new peak right around 2026. When you combine these 3 factors, unprecedented valuations, a teetering commercial real estate sector, and a crushing mountain of sovereign debt, all timed with the potential peak of a historical economic cycle, the picture becomes terrifyingly clear. Buffett's sale is not a bet against a single company. It is a bet against the stability of the entire system. Section 4. The Buffett Solution. Crisis as Opportunity. This picture is bleak, but to see it only as a warning is to miss the most important part. For Warren Buffett, a market crash is not an apocalypse. It is the sale of a lifetime. His actions are not just a warning. They are a roadmap. Lesson number 1. Cash is oxygen. The average investor is taught to fear cash. Buffett's $157 billion cash hoard is a direct refutation of that idea. Cash serves 2 purposes. First, it is defensive. It is financial oxygen. When a crisis hits, those without cash are forced to sell their assets at the worst possible moment to survive. They become forced sellers. Having cash ensures you are never a forced seller. The second purpose is offensive. A market crash is a massive sale. Cash provides the power to act decisively when panic is at its peak, and high-quality assets are being sold for pennies on the dollar, just as he did in 2008. Lesson number 2. Make your shopping list before the sale. Buffett is not a market timer. He is a preparer. One of his most famous quotes is, "The time to get interested is when no one else is. You can't buy what is popular and do well." Right now, he is watching. But you can be sure he has his shopping list ready. He knows which businesses he would love to own, and he is simply waiting for the market, in its panic, to offer him a price he is willing to pay. This is a strategy anyone can replicate. Do the research now, while you are rational. Identify the great companies you want to own and determine the price at which they would be a bargain. Then you wait. When the crash comes, you won't need to think. You will have a plan. Lesson number 3. Embrace simplicity. Avoid speculation. The current market encourages complexity and gambling. Buffett's philosophy is a rebellion against this. His strategy is brutally simple. Find a great business, don't overpay, and hold it. His retreat to cash is a retreat from the speculative mania. The lesson is to simplify. Look at your portfolio. Are you invested in businesses you understand, or a collection of popular tickers you can't explain? When the tide goes out, as Buffett warned, you discover who's been swimming naked. The speculators will be wiped out. The disciplined investors, holding cash, will be ready to buy what they are forced to sell. If this opened your eyes to where we actually are in the sequence, subscribe. Because when we hit the next stages of the pattern, you'll want to understand what happened and why. The answers aren't hiding in the future, they're written in the past. Section 5. Your personal arc. A 3-step plan. Knowledge is useless without action. Building your own financial arc requires discipline and a clear plan. Here is a 3-step plan to prepare. Step 1. Stress test your foundation. You must be brutally honest about your financial vulnerabilities. Ask yourself, if the market were to fall 40% tomorrow, would I be okay? If I lost my primary income for 6 months, could I pay my bills without going into debt or selling my investments? This isn't about fear, it's about identifying your breaking points. Where is the leak in your own roof? Step 2. Build your cash fortress now. Follow Buffett's lead. Start building your cash reserve immediately. Your first goal is to accumulate enough cash to cover 6 to 12 months of essential living expenses. This is your survival fund. It is what gives you the peace of mind to not be a forced seller. Then, start your opportunity fund. With every paycheck, allocate a specific percentage to this fund. This is money you are intentionally setting aside to deploy into the market after a correction. You are transforming yourself from a potential victim into a potential beneficiary. Step 3. Prune your portfolio. This does not mean sell everything. It means becoming a disciplined gardener. Look at each of your holdings with an unemotional eye. Ask, knowing what I know now, would I buy this stock today at its current price? Be ruthless in pruning the speculative weeds. Rebalance away from assets at bubble-like valuations and rotate those profits into cash or more defensive sectors. Align your portfolio with quality and value, not hype and momentum. The signs are undeniable. The world's most successful investor is making his most defensive move in decades. His own indicator is screaming that the market is playing with fire. And deep cracks in the economy are widening. Wall Street may tell you to ignore the pattern, but Buffett's multi-billion-dollar actions speak far louder than their words. This warning does not have to be a forecast of doom. It is a call to prepare. It is a chance to adopt the very playbook that has made Buffett a legend. Be patient, be disciplined, and be ready. The 2026 crash may be a statistical probability, but for the prepared, it is not an end. It is a beginning. It is the sale of a lifetime. The only question is, when the sale starts, will you be ready?